So we're here with Buck Joffrey, and this is Andy Tanner. How you doing?
Good, Andy.
And we talked about a Warren Buffett strategy, and a lot of people think Warren Buffett just buys and holds. Here's 2.5 billion in revenues from selling options. Here's 7.6 billion, and he sells these options all the time. So I thought, wouldn't it be fun to just do a little work here and talk a little bit about how these work and what they look like. Is that cool?
Yeah, absolutely.
So let's say here, we'll just draw some stick figures to make this easy. And what happens in an option contract is a lot like a rental contract. And so let's do a rental contract first. I know you have some real estate investors. We'll draw a house. And one guy gives a promise. He says, I promise you that you can stay in my house for 30 days. And then after that, you'll have to give me some more rent. So this is called a rental contract. And another word for contract is a promise or a guarantee, rental contract. And for that, the guy pays rent. And so on an income statement and a balance sheet, if this is income and expenses and this is assets and liabilities, he has the house here as an asset and the rent comes in like this. So maybe the rent's like $1,000 and there you got $1,000. Pretty simple, right?
Mm-hmm.
Okay, that's pretty simple. Well, let's say that over here, that this is Warren Buffett. It looks just like him. See that? See how nice that looks? I didn't know I was an artist. Uh-huh. And over here is, Joe Investor or whomever. And Buffett wanted to buy Coke. It was at $39 a share. So this is the drink, not the powder here, Buck. It's the drink.
Yeah.
And Buffett loves Coca-Cola stock. And he says, you know what? It's at $39 a share. He might buy it anyway. And so if he were to buy that, let's go scenario number one here. If he were to buy at $39 a share, his risk would be $39 times however many shares he bought. I mean, that's the ultimate risk. If Coca-Cola goes bankrupt, he's going to lose 39. Does that make sense?
Mm-hmm.
So that's scenario number one. Well, let's say that Buffett says, you know what? I would buy it. I'd be more willing to buy it at 35. Maybe he looks at a chart and he thinks, here's 35. And if it went down and down and down, he wouldn't care because he thinks long-term it'll go up. So he's not really concerned about little dips in the market. It's at 39 today. He'd be willing to buy at 35. So he says, you know what? I'll make you a promise. I promise to buy so many shares of Coca-Cola at $35 a share. And maybe this is like 30 days, 45 days, whatever it is. Okay. Whatever it is, 30 days, 45 days, whatever. Now, Joe over here, he's nervous. Joe over here, he's scared. He owns some Coca-Cola. And it's up here at 39 a share. And he says, I could handle a $4 drop, but if it went further than that, I'd be nervous. So I want the choice. And what's another word for choice that starts with an O? That shouldn't be too tough.
Option.
Yeah, it's an option. So I want the choice to sell this to Warren at $35 a share anytime for the next 30 days or whatever the time is. Now, someone's going to say, well, Andy, what if it goes below 35? Well, that's a risk you were willing to take anyway if you're going to buy it at 35 or 39, right? There's no more risk in this than buying the stock. And you can always get out of this contract if you want. So the Buffett goes to the market and he says, well, how much are these going for, these promises? And the guy says, well, they're going for about $1.50. So he says, I'll take 5 million. And so that means that now Buffett, his asset column right here, has some cash in it. But because of that promise, he just got $7.5 million, $1.50 times 5. Now watch this. If the stock goes up, Warren's pretty happy. Why? Well, he gets the 7.5 million on a stock that he never actually had to buy. He just gets that premium and keeps it. If the stock remains sideways, he's pretty happy because he gets $7.5 million. He won't buy the stock. And that makes sense, isn't it? Because it's his choice, right, Buck? It's just, this guy doesn't have, if the stock's at 41, why would he sell it to Warren at 35, right? If the stock's at 39, why do we sell? It's an insurance company. It's like, hey, my house didn't burn down, but I still pay the premium, right? My house didn't burn down. Now, let's say it goes down to 35 or lower. He's still happy. Why? Because he would have bought it at 35 anyway when it was at 39. If you get $4 off on it, he would have bought it anyway. He gets his $7.5 million plus he gets 5 million shares of asset. Now he has Coke in his asset column. He got paid $7 million to do it. And if it goes down to 33 or 32, that's a risk he was going to take anyway. And he thinks long-term it'll go up anyhow. Does that make sense?
Yep.
So that's basically what this strategy is. It's called a naked put or a cash covered put since he has the cash. And in this number 2 scenario, let's look at what his risk is. Well, now his risk is 35 minus the $1.50 that he already brought in. So what is that, $33.50?
Yeah.
So his risk actually goes down significantly doing this strategy. Let's do one for real, shall we?
Let me ask you a question here, Andy.
Go ahead.
Real quick. Occurs to me that the guy selling the options, he's in a pretty good position too, because he may have made a whole bunch of money on Amazon already.
Yeah.
And he's thinking, you know what? I'm sort of trigger happy already. Well, let me just ride this out a little bit more. And if it happens to start sliding, well, instead of just having a sell an option, just having an option to sell at that point, you could just you just trigger it and make money at the same time because you sold that option already. So either you were going to sell it at that point anyway, or you made money for selling it at that point.
Yeah, what this guy makes happy is maybe he bought it at 20 and it's gone all the way up to 39. And he says, look, if this starts heading back down, I don't want to wait till it gets to 20 again. I want to sell at 35 anyway. I want to guarantee to do that. So I'm willing to pay Warren Buffett $1.50 because whoever makes the promise gets the money. That's important to understand. Just like insurance, whoever's making the promises collects, and this is even called a premium. That's the name of it. It's even called a premium. So whoever makes the promises gets the cash up front. But you're right. Joe might be absolutely thrilled that if all of a sudden this dropped down to $33 and Warren has to pay $35 for it, he's as happy as he could be because at least he got the chance to sell his stock at a price he wanted to sell it at. And if he bought it at 20, down here, if he sells it at 35, he's got a $15 profit locked in. So what he's doing is says, look, I'll pay $1.50 to lock in a $15 profit if he bought it at 20, if that's where it was.
Right.
So these happen all the time. Now here's what's interesting, and I use this one on your show. I would probably look for a better premium than this, but it's still going to work out pretty darn cool. So you mentioned Amazon. You just I don't know if you own Amazon or if you just pulled that out of the air.
Stocks.
Okay. Amazon's a little expensive. I would not buy Amazon because they're based on growth instead of cash flow. They have one of the worst PEs ever in the market, meaning you're just paying a ton per share. But they're at 1,600. So let's just bring up this right here. And you'll notice that, if I were to buy this, here we have a point. I'm going to draw this in blue. Here we have a point called resistance. And often resistance will turn into support. So, it blew up here on earnings and it came back down. You'll notice that the old resistance became support, and starting to climb again. So I might say, I'm not really interested in buying at 1,600, but if it got down here to 1,550, I might be a buyer to see if it'll make another bump. Does that make sense?
Yeah.
And we call that technical analysis. When you look at a chart and make decisions like that, technical analysis. We also see that even though this is rising, we see volumes declining. So we're really not too excited about buying at 1,600 right here, because even though the stock's gone up, the participation in this has gone down. It's not impressing us. Certainly a nice volatility crush on Amazon, but really this thing's got to come back down here to where I'd be interested again. It really does. It's got to get back down to 1,550. So I would go to what I call an options chain, and this could get confusing for some people because I move around a lot, but in our Mentor Club, we help people work it out. So let's say we go out to the 22nd of June. That's about a month away from where we are right now. It's just about a month away. And over here we have put options, and over here we have call options. And let's just get down into reality here with all these strikes. And let's say that you know what, let's not even go to June. Let's just go out to like the 15th. Let's not even go out that far. Let's just go 30 days from now. It's May 14th as of this recording, right?
Mm-hmm.
So let's go to Amazon, which is right here at 1600. And I say, you know what? The puts right now, they're bidding $21.05 for that 1550 where I wanted to buy it. So what that means is if we take this down like this, here's you, right? You're very handsome. See, I'm as good at drawing you as I am Buffett almost. Very handsome.
I'm a little taller.
And here is here's Joe Investor over here. And you say, you know what? I'll promise to buy Amazon. Let's see if I can get it right. Amazon at what did we say? 16 or 1550?
Mm-hmm.
And that's good for 30 days. That's good for 30 days. He's going to have to pay you $21.05 to do that. Now let's talk about what this would look like in your balance sheet. And again, I'm not a big fan of Amazon at these prices. So we'll do our disclaimer, educational only, all that good stuff. But let's say you've got some cash in here, just like cash in the bank, and it's not earning much interest in the bank, is it? But by having the cash to buy Amazon, by having this cash to buy this stock, we're going to get this premium of $21.05 in income. We have no debt here. We have no liability here. So that's going to be a cash flow of $21.05. Now let's look at that from a return on investment standpoint real quick. Okay, this will be interesting to you. So here we have a month. So we have $21.05 divided by $1,500 or $1,550 is what we're going to do this at. So that's about 1.3% on our money. Doesn't sound too exciting, does it? But understand this is per month, right? Mm-hmm. So to annualize this, to really see what it would be doing annually, I have to times it by 12, see? And now you're at 16.2%. And that's a pretty good return, 16.2%. So let's see what happens if this stock goes up. Right now it's at 1600. If the stock goes up, this guy has the choice to sell this stock to you, to sell your Amazon at 1550. He has the choice to do that. He wouldn't do it. Why? Well, if it's above 16, why would you choose to sell it at 1550, right?
Right.
So this option will expire worthless and you keep that cash. If the stock stays the same, it's the same scenario. 15, if it stays at 16, why sell at 15? The option will expire. You keep it. So up here, you're happy. You keep the 2105. Right here, you're happy. You keep the 2105. Now, let's say it goes down to 1550 or below. That's a risk you're willing to take anyway by buying the stock. And right here, you're really not that sad because you still keep the 2105 and you get to buy this. And what's interesting, even if it went down to 1530 or 1529, you'd still be ahead in the trade because you got 21 up front, right? Mm-hmm. So people see this, they're like, no wonder Buffett does this. This is a pretty good deal for you. Up, down, or sideways, you get to make 16% annualized, and you can do better than that. That's not actually the best price on a cash covered put. And we do this all the time. This is a simulated trading account, Buck, so it has no risk in it. And we have a portfolio that we manage week to week. Right now, this is ours. And we try to do about $1,000 a week in simulated trading. We demand people go simulated before real. And we've got two of them right here. Right now, we have Micron. And you can see that we have promised two contracts here at a strike at 50. So if we look, and we've picked up, well, I'll show you on the chart here. On Micron, we've picked up MU. This is going to be a little bit better numbers because, Amazon was just, we pulled that kind of out arbitrary. But right here, we decided to sell 2 contracts short at 227. So 227 times 2, you can probably do that math in your head. In your head, you can do it in my head, but we use the calculator just because I'm getting old. So we got $2.27 times 200 shares is $554, which is about like a rental house, right?
Right.
It's about what you'd cash flow off a rental house. So I'll put these side to side. Let's say that I have a rental house and I bring in, I borrow $100,000. So now I have a house and my payment is like, we'll just say 700 or something like that. And let's say the rent on the income side is, let's just call it $1,100 in rent. So your cash flow would be 400. Fair enough? So real estate investors would understand that. Well, watch what we're doing here. We'll put this in the same color just for fun. Here we have some cash in our asset column. So instead of a house, we have cash. Cash is liquid. It's agile. We can move it around. And right here, we made a promise called a rental contract. And it's made up of 30 days, right? Contract, 30 days. That's what that looks like. So they've paid us $1,100 for this rental contract. Here we have no debt. We have no payment. So we didn't use any leverage. We just have cash. And the promise was simple. The promise was to buy 200 shares of Micron at $50. And they paid us $404. There's no debt there. So we got $454. Well, how much cash would we have to have in here? Well, Micron, we said we'd buy it at what price? $50, 200 shares. So 200 shares times 50 is about what? About $10,000. Of this, you'd have to put about $25,000 to get a rental because there's usually 20. So here you're going to make your 454 on 10 Gs. Here you're going to make 400 on 25 Gs in equity. Well, what's exciting about this trade right here, are you following this so far? Am I going too fast? So what's fun about this trade is if you look at Micron's chart, we agreed to buy it at $50, okay, right down in this support area right here. We agreed to buy it at $50. Right now it's at 53. So it'd have to come down $3 for us to have to keep our promise at 50. Well, what's fun about this is this gray area right here that I'm shading in. That gray area is called a standard deviation. So this contract is only till May 26. We're almost done with it, okay? Then it'll expire. There is a 75% chance that the stock will stay above 50 and only a 24% chance that we'll actually own this stock. And if you look at the numbers on this, just from a calculator standpoint, if you take this $10,000 that we were going to risk to buy this, if you go 454 and you divide that by $10,000, is that 10,000 or 100? 10,000. That's 4%. Now we get to annualize that. See, that's a little better one than Amazon. That's a lot better. So,
wow.
So if someone says, Andy, can you do 10% in a month? Yeah, I can do 10% in a month, but I don't guarantee that to anybody. And I've had months where I've done worse than 10%. But as long as this stays right here above this line, I'm just going to keep the 454. If it goes to here, right at this line, I'll keep the 454 plus I'll buy 200 shares of the stock at 50. And here's what's really funny is since I brought in, $2.27, I get to bring this down $2.27 to a break-even point right here. So there's only a 10% chance that I'll buy that stock at break-even. Only 10% chance. And the chance I'll buy it $1 cheaper than it's supposed to be is only 5%, and a chance I'd buy it $2 cheaper is only 3%. So my chances of getting beat on this are really, 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 really small. And even if I did decide to buy it right here, because I promised to it, if I decided not to get out of the contract and I do buy it in this area, I have an asset that I can write covered calls on and get dividends and get cash flow other ways. So we did this on Micron. We also did this on US Steel, where here we promised to buy US Steel. It's sitting up here right now at $30. $36 and change, 36.25. We promised to buy it at 30. So if you look at the chart, we said, yeah, it's clear up here at 36. We'd be willing to buy down here at 30 if we got it cheap. If it goes up, we keep the money. Sideways, keep the money. Down, we keep the money. We start to lose right here, but we like all this support in here. We wouldn't mind being a buyer even right here. We think Micron's a good company. We wouldn't mind being a buyer even that cheap. And our chances of being successful in this trade are 94.94%. There's only a 5% chance we'd wind up buying it below that cost. So for doctors, lawyers, especially engineers would be so good at this if, because they're wonky like me. They like these numbers and essentially that's it. So that might be a little bit more clear about how Warren Buffett does this. Warren Buffett
was awesome.
Says, give me some cash here in premium. I will promise to buy stocks that I was going to buy anyway, right? I promise to buy your stock on the cheap. I'll buy your stocks cheap if you give me money to do it. So Warren Buffett, to build his asset column, is actually getting paid income to promise to buy stuff. Where a 401k guy has a job and he brings this money and he's going to put in the 401k, but he's going to pay fees out. This is a better model, in my opinion, than the 401k model where we pay fees to build our asset column. Here, we're getting paid to buy stuff we were going to buy anyway. So if a guy's going to build a 401k anyway, why wouldn't he want to get paid to buy those stocks? Instead of paying to buy those stocks, if that makes sense.
Absolutely. Makes a lot of sense, eh?
So any questions on that? We were just talking, thought it'd be fun to do a little class on it.
Absolutely. I think that's going to be great. And I'm sure people will learn a lot. And if you want to get more involved in this, definitely go check out Andy's mentorship program and other educational stuff.
Well, cool stuff. Thanks for the time, Buck. And anytime you got a question, go ahead and give me a call.
Thanks, Andy.
Awesome.
If you want to learn more, you can now get free access to our in-depth personal finance course featuring industry leaders like Tom Wheelwright and Ken McElroy. Visit wealthformularoadmap.com.